Energy stocks have pulled back dramatically from their highs. I'll give you a few names of companies I own in my personal portfolio, a few of my favorites at the end of the video, but I wanted to give you a full explanation on why energy prices have come down and energy stocks have come down so significantly. The first and the easiest one to see is the Strategic Petroleum Reserve. So we basically have had this reserve going since 1982, near the end of the first energy crisis. Oil actually bottomed in 1986. And then you can see up through where we are currently, we've got a situation where the number of barrels in the reserves has dropped to 370 million barrels, well down from where it was a year ago at the start of the invasion. They've been depleting the Strategic Petroleum Reserve by about two-thirds of a million barrels a day over that time frame. And you can see it's well off of the highs that we achieved back in 2011. So what has occurred is, as energy prices spiked last year, in order to reduce inflation and reduce gasoline prices for consumers, we started tapping into this Strategic Petroleum Reserve. That unleashed additional supplies onto the market, and those additional supplies managed to drive prices down. So prices for crude oil are now significantly below where they were back before Russia invaded Ukraine. So we've had a full round trip on prices. We did get a big spike right at the time of the invasion, got up to around $130 billion, so $130 a barrel. We're now back down into the $80 a barrel neighborhood. So big round trip. This is one of the primary reasons. The other reason is that Russia has been forced to basically sell its market almost on the black market. So they're getting a discount versus what they have gotten historically. And that has soaked up a fair amount of demand from like China and India, big two importers of crude oil. And so a lot of their oil has been going there at discounted prices. So it's had a dampening effect in general on the price environment, overall. Russia has indicated that they're going to start reducing their discount, and so that discount is going to start to come out of the market. And at some point, this Strategic Petroleum Reserve is going to have to be refilled, which will mean a swing of somewhere in the neighborhood of at least 700,000 barrels a day to as much as 1.7 million barrels a day. So a big swing. That's a big number for the U.S. The U.S. consumes about 20 million barrels a day of crude oil. So this is the reason oil prices have come down, gasoline prices have come down. It really is detrimental to the long-term pricing impact, because what happens is when the price comes down, crude oil producers are not incentivized to search and drill for more oil. So those are on pause. And they're still doing a fair amount, but not near as much as they would be doing if the crude price was at 120. And so when you have less search, it means you have less production, not maybe today, but you're going to have less production out of the U.S. and out of the globe of crude oil in 2 or 3 years than you would have had if prices had stayed above 100. So that is going to drive the price up longer term. So we're very confident over the longer term basis that crude oil is going to go back over $100 a barrel, which would be supportive for pricing. So this is the big one that's easy to see. The other area that's been a little unusual is, natural gas prices went crazy after the invasion, primarily because Russia is a huge exporter, or was a huge exporter of natural gas into Europe. And Europe needed to have its supplies substituted with global LNG and US LNG, which is liquefied natural gas, to get through the winter period and produce electricity etc. That has caused a significant demand surge for liquefied natural gas, tankers, etc., and the price shot up. After the summer, there was an accident at a Freeport liquefied natural gas plant. That plant got shut down. That reduced demand for natural gas and the ability to export it. And also, the winter in Europe has been unseasonably warm, which meant that natural gas use for heating has been reduced, and also for electricity production. So natural gas demand had a big hit in Europe, and so we basically have had natural gas back up to unseasonably high levels for this time of year, and the price has absolutely collapsed. It's down about 75% from its high. So a big collapse in the natural gas price, primarily because of warm winter in Europe and the Freeport situation. Longer term, natural gas continues to be the current energy of choice for electricity generation. The world is trying to move off of coal, which is dirty, but the world is not quite ready to embrace renewables. Solar has its efficiency problems, intermittent ability to produce electricity. Storage of electricity is a difficult item to accomplish cost effectively. So natural gas still is a go-to for extra electricity production. So in that mind, we do think that demand for natural gas is going to be increasing over the years, and that is pretty much in line with most people's thinking. So we have a long runway of increasing demand. We do think that this price anomaly in the natural gas commodity itself should unwind by next winter. And when prices resume, earnings, cash flow, free cash flow, and dividends for our exploration and production companies should surge. In order of companies I really like Comstock. Symbol is CRK. Comstock is in a situation where they've got a nice resource base, which will allow them to increase production basically at a pace of whatever they would like. So I think they're going to be able to grow production at 5 to 10% a year for a while. In addition to that, it's very low cost production. They pay a nice dividend today, and they're going to have earnings per share growth. So we think that that is probably the most attractive stock, both from a dividend and capital appreciation standpoint. One other that fits into that category, I would say, is Civitas. Civitas also has a nice dividend, very low valuation. Civitas is Orly versus Comstock, which is primarily natural gas. So it gives you some diversification in that. But here again, they pay a dividend, and we think the stock has ample room for capital appreciation. And then some other names that I like and I own are Vital, symbol VTLE, Ring, symbol REI, Southwest, symbol SWN, Ranger, symbol ROCC, Aventiv, symbol OVV, and on the natural gas side, Chesapeake, CHK. So a whole list of companies that I think are attractive. I do own a very large position of energy stocks in my portfolio. I think that this is a multi-year run that we're experiencing. The stock's valuations are very compelling. The next couple of quarters are going to have some blips as people have to take into account very low natural gas prices on their sales. But I do think that is a temporary blip, and the fact that the prices have collapsed, you've actually started to see shut-in of natural gas, less drilling for natural gas. So we're already in the midst of seeing the background of what is necessary to get gas prices higher. The Freeport LNG facility is coming back online, and then in all likelihood, the world will not have abnormally warm, off the charts winter like it did this winter next year. So things are lining up very positively for this sector. Please take a look at these companies. We have full reports on these on our website. And please remember to take a look at our website to see our full disclosure. This just happens to be what I own in my own portfolio. I'm providing this to you for educational purposes, and this is not an investment recommendation. Our full disclaimer is on our website, buildingbenjamins.com, and you can also sign up for email and text alerts. Hope you have a great day. Thank you.